With crypto trading at record highs, record volume, and our current president making sure that the U.S. has a crypto czar, a digital coin czar, making sure that we are going to be investing in digital assets as a country, it is so important that we understand how to manage our cryptocurrency and what the tax implications are. My name is Karla, and in this video, I am going to educate you on what you need to be doing right now in order to ensure you do not get yourself in a tax slinky. We cannot afford any mistakes. That is why I want you to like, comment, and subscribe so you don't miss out on any of this wealth building information. Now, let's get after it. First of all, we're going to talk about the basics of crypto. You got to understand the terminology before you can even invest in crypto. One of the most important things for you to understand, as much as crypto is a digital asset and we can purchase things with crypto, crypto is considered property currently in the U.S. tax code. That means that if you sell crypto, you are going to get hit with capital gains tax. That is really important for you to understand. That is one of the first things that I need people to know. That means if you sell crypto, if you trade crypto, if you buy something with crypto, you have created a taxable event. You may be thinking to yourself, Karla, what do you mean a taxable event? Whatever the value of that crypto was on the day that you purchased that asset, or purchased whatever it is that you're buying, you in essence sold your crypto for that value. You have a reportable sale. And many of you are not aware of that, but you will become aware of that when IRS starts knocking on your door, because they have created a digital department inside of IRS to focus on audits of individuals that own cryptocurrency. When you sell crypto and you're going to be in a capital gains perspective, it's very important for you to understand long-term capital gains versus short-term capital gains. A long-term capital gain is when you hold your crypto for a year and a day and then you sell it. That is considered long-term, meaning it's going to get taxed at the long-term capital gains rates. If you do not hold that crypto for a year and a day, you are going to have a short-term capital gain. Short-term capital gains are taxed at ordinary income tax rates. And there is a big difference between ordinary income tax rates, highest rate being 37%, versus a capital gain rate could be as low as 0%. So making sure you understand and planning out your strategy when you are selling, trading, or using your crypto is really important to keep your taxes as low as possible. With the way the volume of crypto is trading right now, it is up about 25%. It's so important that you really understand the difference between being taxed at a capital gains rate and being taxed at ordinary income tax rates. Remember, a year and a day get you long-term capital gains rates, and less than a year get you ordinary income tax rates. And that delta between the two can make a difference in your tax liability. So make sure you're paying attention when it's time to move your crypto, sell your crypto, trade your crypto, or purchase something with your crypto. Many of you are wondering, what happens when my crypto drops in value? Well, one of the things that you can do if your crypto drops in value is to look at whether or not tax loss harvesting is an option for you. Tax loss harvesting is where if you purchase crypto at one price, let's say you purchased it for $1,000 or $10,000 as an example, and let's say you now sell it for $9,000. You have a loss of $1,000. If you sell off all of your crypto at a loss, you can harvest those losses, which means you're growing your losses. You actually allow a taxable event to happen. That's what harvesting your losses mean. You sell your crypto at a loss, therefore you're harvesting your losses. Your losses can go against any other capital gains that are on your tax return. And up to $3,000 of that capital loss can offset other income that is on your tax return. So as you get down to the end of the year and you're thinking about what your strategy needs to be, think about tax loss harvesting. Keeping accurate records of your crypto is essential. As a tax professional, I cannot tell you how many people come to our firm to get their taxes done and they have no idea how to gather the information on how much they sold in their crypto, how much they paid for their crypto. This is so important. Why? Because I can guarantee you, if IRS has to figure it out, you're probably going to err on the side of making sure you report extra income and pay extra tax. That's why it's important to get some crypto software. There's a lot of different softwares out there on the market, and you can certainly Google for it. But whatever you do, get some software so that you can make certain that you have the appropriate income when it comes time to file your taxes and you don't end up in a tax slinky. When you invest in crypto, the onus is on you as a taxpayer, as the investor, to make certain that your crypto is reported correctly. You have to provide your tax professional with the right information so they can file Form 8949 for you. And regardless of whether you received any documents on your cryptocurrency from the house that you buy your cryptocurrency from, doesn't matter. You have to be the one that reports it. So make certain you stay on top of keeping track of your crypto, make certain you stay on top of the laws, and make certain you know how much you paid for it, how much you sold for it, and if you bought anything for it, because you may incur capital gains tax or ordinary income tax. Here's the thing, now that you know better, you absolutely have to do better. I want you to like, comment, and subscribe because crypto tax laws are going to be changing, and it's going to be one of those laws that is going to be constantly moving. I want to make certain that you stay up to date.